Prepaid or deferred expenses are those paid before the expense is incurred, that is, before the goods are used or the service is performed. When an expense is paid in advance, the amount is recorded in an asset account such as prepaid office supplies, prepaid insurance, or prepaid rent. As the goods are used or the service is performed, the asset account is reduced and the corresponding expense account is increased. In accrual basis accounting, a prepayment cannot be recognized as an expense. Only after the expense has been incurred can the business recognize the expense. Prepaid or deferred expenses involve both a transaction entry and an adjusting entry. The original transaction entry is made when cash is paid. The adjusting entry is made at the end of the year or other period. Debit an asset account known as a prepaid expense account and credit cash. The prepaid expense account title will describe the type of prepaid expense involved, such as prepaid rent, prepaid interest, or prepaid office supplies. The transaction entry to record a prepaid or deferred expense is as follows. Debit prepaid various title. Balance sheet asset account. Credit cash. Balance sheet asset account to record prepayment of various expense. Note that the transaction entry involves two balance sheet accounts. Adjusting entries involve a balance sheet account and an income statement account. The adjusting entry at the end of the period simply transfers the amount of the expense that has been recognized or used up from the asset account to the expense account. Debit various expense, income statement account, credit prepaid various, balance sheet account to recognize various expense. Examples of prepaid expenses include prepaid insurance, supplies on hand, that is, office or other supplies used from day to day, not an inventory of supplies that are sold to customers as is or processed and then sold. Prepaid rent, advance payments for various services. Failure to record an adjusting entry will have the following impacts on the financial statements. Assets will be overstated on the balance sheet because the omitted adjusting entry would have reduced an asset account. Expenses will be understated on the income statement because the omitted adjusting entry would have increased an expense account, and as a result, net income will be overstated on the income statement. On October 1st, 2019, Buco, a calendar year company, prepays a one-year insurance premium of $30,000 and records the payment in prepaid insurance. What entry does Buco record on October 1st? What entry does Buco record at year-end? Debit prepaid insurance, $30,000. Credit cash, $30,000 to record prepayment of one-year premium. Cash is credited because cash is being paid. The asset account prepaid insurance or unexpired insurance is debited to increase the account by the same amount. The adjusting entry at year-end is debit insurance expense, $7,500, credit prepaid insurance, $7,500 to record insurance October through December expense. $30,000 divided by 12 months equals $2,500 per month times 3 months, October, November, and December, equals $7,500 insurance expense used up by year-end. At year-end, the adjusting entry debits insurance expense, increasing that account by $7,500 to recognize insurance used up. The entry credits prepaid insurance, reducing that account by the same amount, leaving a balance of $22,500. That is $30,000 minus $7,500. To illustrate with T accounts, where A indicates the original transaction entry and B indicates the adjusting entry. During the year, your firm buys $18,000 in office supplies and records the entire prepayment in prepaid supplies. At year-end, you have $4,000 of supplies on hand. Record the transaction and adjusting entries. Transaction entry using prepaid supplies. Debit prepaid supplies, $18,000. Credit cash, $18,000 to record supplies purchase. Adjusting entry. Debit supplies expense, $14,000. Credit prepaid supplies, $14,000 to record supplies expense. That is $18,000 minus $4,000 equals $14,000. The debit to supplies expense recognizes the $14,000 of supplies used up as of year-end. The credit to prepaid supplies reduced the asset by the $14,000 of office supplies that were used up. Prepare the adjusting journal entry for each situation. Your company prepays $12,000 of rent for 1 year and debits prepaid rent. Your company's year ends 4 months later. Debit rent expense $4,000, credit prepaid rent $4,000 to recognize rent expense, $1,000 per month times 4 months. The original entry debited prepaid rent for the entire $12,000 prepayment. At year end, the $4,000, which is 4/12 times $12,000, is rent used up, must be transferred to rent expense. Your company buys $30,000 of office supplies and debits prepaid supplies. At year end, there are $9,000 of supplies on hand or unused. Debit supplies expense $21,000, credit prepaid supplies $21,000 to record supplies expense, $30,000 minus $9,000. The original entry debited prepaid supplies for the entire $30,000 prepayment. At year end, the $21,000 must be transferred to supplies expense. The remainder stays in prepaid supplies until it is used up in the future. Your company prepays $18,000 of rent for 1 year and debits prepaid rent. Your company's year ends 4 months later. Debit rent expense $6,000, credit prepaid rent $6,000 to recognize rent expense, $1,500 per month times 4 months. The original entry debited prepaid rent for the entire $18,000 prepayment. At year end, the $6,000, 4/12 times $18,000 in rent used up must be transferred to rent expense. Your company buys $40,000 of office supplies and debits prepaid supplies. At year end, there are $6,000 of unused supplies left. Debit supplies expense $34,000, credit prepaid supplies $34,000 to record supplies expense, $40,000 minus $6,000. The original entry debited prepaid supplies for the entire $40,000 prepayment. At year end, the $34,000 must be transferred to supplies expense. The remainder stays in prepaid supplies until it is used up in the future. On November 1st, your company signs up with a law firm for an agreed-upon retainer of $15,000 a year, paying the first 3 months' fee in advance and debiting prepaid legal fees. Record the adjusting entry on December 31st. Debit legal expense $2,500, credit prepaid legal fees $2,500 to record advance on law firm retainer. $15,000 annual retainer divided by 12 months equals $1,250 per month times 2 months equals $2,500. Although 3 months' expense was paid in advance, the date of payment was November 1st, so only 2 months' expense can be recognized for the year, November and December. You give LICO a $12,000 advance on a $100,000 paint job and record it in prepaid painting expense. By year-end, LICO has completed 10% of the job. Record the adjusting entry. Debit painting expense $10,000, credit prepaid painting $10,000 to record painting expense, $100,000 times 10%. The original entry debited prepaid painting expense for the entire $12,000 prepayment. At year-end, $10,000 must be transferred to painting expense to recognize the 10% of the job completed. $100,000 job times 10% completed equals $10,000 expense that can be recognized. The remainder stays in prepaid painting until it is used up in the future. You prepay $24,000 for 2 years of insurance premiums and debit prepaid insurance expense. Your company's year ends 4 months later. Make the adjusting entry. Debit insurance expense $4,000, credit prepaid insurance $4,000 to record insurance expense, $1,000 per month times 4 months. The original entry debited prepaid insurance expense for the entire $24,000 prepayment. At year-end, $4,000 of the insurance has been used and therefore must be transferred to insurance expense to recognize the expense. The remainder stays in prepaid insurance until used up in the future. You prepay rent and debit prepaid rent. If you do not record the adjusting entry at the end of the period, total assets on the balance sheet will be A. Understated, B. Overstated, C. Unaffected. B. Overstated. Failure to reduce prepaid rent by the amount of the rent expense used up for the period will result in the balance in prepaid rent, an asset, being overstated and therefore overstating assets on the balance sheet. You prepay rent and debit prepaid rent. If part of the time covered has elapsed and you do not record the adjusting entry, net income will be A. Understated, B. Overstated, C. Unaffected. B. Overstated. Unless the amount of rent used is transferred to rent expense at year-end, the balance in rent expense will be too low, making overall expenses too low and overstating net income.